There are times when an investor's patience is tested, especially in the short term. This may well be one of those times. I'm Mark Kinney, Chief Investment Officer with Newport Private Wealth, with your second quarter update. There's no question the past 3 years have been unprecedented. For some investors, it's tempting to look in the rearview mirror and think about whether different decisions might have yielded different results. But that's not Newport's approach. Recall that we position our portfolios to perform over rolling 3 to 5 year periods, not 3 months. Over this longer period, there will be times when we'll perform well and times when our performance will lag the market. The goal is to outperform our benchmarks over the full market cycle. This is a deliberate strategy and one from which we haven't veered from for many years. As an illustration, in 2021, our fund's performance was strong in absolute terms. In 2022, fund performance was strong in relative terms. Both measures reflect the strength of our diversified portfolios and the active management of our investments. Fast forward to 2023, and universally, diversified portfolios are underperforming, as is typical when a handful of names are providing all the direction in the equity markets. Newport's portfolio is no exception. As 2023 unfolds, the outsized rally of a handful of public equity mega-cap stocks, powered by the artificial intelligence frenzy, are skewing performance. At the mid-year mark, our 5 mandates are lagging their benchmarks. Despite this, it's important to remember that performance is in line with our expectations. To provide context, let's look at the performance of the Newport Balance Fund. Despite market turbulence over the last 3-year cycle, we continue to protect capital and generate the returns we seek. Sticking with prudent decision-making is the most effective way to achieve this. In the quarter, we watched for opportunities to put capital to work where the risk-reward balance was in our favor. For starters, we began to allocate cash to the bond markets. Bonds benefited in the quarter from the aftershocks of the banking crisis. The current cycle of interest rate hikes has made bonds look as attractive as they have in a decade. We invested $10 million in April, bringing total bond allocations in 2023 to $25 million. We speak regularly with our fixed income sub-advisors to help with our decision-making. For the time being, we remain underweight bonds. We'll keep a keen eye on this asset class as the year unfolds and interest rates stabilize to invest more. It's worth noting that investing in bonds offers superior tax benefits compared to GICs. The total return of bonds can include capital gains, which are taxed at a lower rate than GIC interest income. GICs also have poor liquidity. While investors can cash a GIC before maturity, this comes with a cost. Bonds are highly liquid and can be redeemed anytime without penalty. It's what makes this asset class an important pillar in our mandates. To complement our bond positions, we diversify through investments in income-producing private debt, mortgages, and private real estate. These safeguard our portfolio when volatility strikes and provide income and growth that are independent of public market performance. New investment activity since April showcased our multi-asset class approach to investing. It also highlighted the flexibility of our strategy. Flexibility allows us to source, analyze, and invest in opportunities with both new and existing sub-advisors that will deliver returns and value over the next several cycles. In the quarter, we added to our infrastructure position through a $20 million investment with a new UK-based manager focused on the shipping industry. The sector has seen significant growth and has long-term potential for upside. The combination of the track record of the manager and the low correlations between this sector and other Newport asset classes proved very compelling. The investment was made after more than a year of due diligence, a reflection of our rigorous review process. On the real estate front, we continue to benefit from our positions in multifamily real estate, while our exposure to commercial real estate remains low. we allocated $25 million to a real estate manager with whom Newport has a long-standing relationship. The fund is focused on private, multifamily, residential, and industrial investments in Canada's largest urban centres. With Canada's projected population growth, the largest of any G7 nation, it's a timely investment. We made a $10 million allocation to a manager who focuses on multifamily residential properties in the southwestern United States. Multifamily is an important cornerstone of our real estate portfolio. We have been investing with this manager for close to 20 years, and their strong track record continues to inspire our confidence in the long-term prospects for our investments. In private equity, we made a $20 million allocation to a Toronto-based manager that we have invested with for many years. The fund is focused on investing in companies poised to benefit from digital transformation in the information, technology, and marketing sectors. In the public equity markets, all eyes have been on the S&P tear of the past quarter. There is a huge disparity in leadership, with only 7 megatech stocks accounting for nearly 10% in index gains. The remaining 490-plus companies contributed less than 1% growth. The boom in tech stock valuations from a narrow group of leaders leaves no margin for error. This is precarious at best. Our allocations to the public equity markets remain regular and consistent, with nearly $50 million being allocated in the quarter. We're not waiting for entry points that are hard to predict and plan for. Time in the equity markets matters more than timing the equity markets. Our weighting stayed at first quarter levels, remaining at the low end of our target ranges. That doesn't mean that Newport is oblivious to the power and impact of technology now and in the future. What it does mean is that we are casting a wider net beyond the public equity pool with its overabundance of big fish. ChatGPT raised awareness of open AI globally. Artificial intelligence has long been used by the world's most innovative companies to power their growth. Through our sub-advisors, Newport participates in investments with these companies. One such company is Align Technology, held in our North American Equity Fund. You've likely heard of Align through one of its most recognizable products, Invisalign, the global leader in clear aligner orthodontic devices. Align is the global leader in 3D printing and has used AI to create customized, predictive dental technology for nearly 15 million people worldwide. AI not only powers its technology, it also increases productivity and creates a model for continuous product improvement. With 80% market share, Align has harnessed AI to reach unprecedented growth. As the manager noted, we believe high-quality companies like Align Technologies outperform over time and provide an important ballast for any investment portfolio. Let's turn our attention to broader macroeconomic issues: inflation, interest rates, and recession. Whether or not a recession is declared still seems to be up in the air. Indicators continue to be mixed. On the economy, Europe appears to be already in a recession that seems rotational. In North America, it looks like the soft landing that many predicted will happen, and in fact a recession may be non-existent. While our sub-advisors don't always agree on what these indicators predict, we tend to be of the view that a softer landing may be in the cards. Regardless of outcome, we are positioned to keep your assets secure with steady returns that we strive to protect over time. Interest rate increases continue to surprise and frustrate consumers who are trying to find stability. We believe that there could be 1 or 2 more rate hikes, given signals from the central banks. We've positioned ourselves to take advantage of those higher rates. This strategy includes having cash ready for opportunities that arise out of dislocation in markets. Over time, this approach has led to steady and consistent returns. We believe it will continue to do so. Regardless of what transpires, we are already looking past potential rate increases to when things moderate. Putting money to work and planning beyond today's rate cycle is critical to long-term success. All of this has led to a stubborn inflationary environment. While we can't predict what the long-term inflation number will be, our experience tells us that the target rate we use in financial projections, around 3%, is reasonable and in line with where we are heading. We are in a different investment environment today than we've had for the past 40 years. In the short term, it can be uncomfortable. Portfolio returns may underperform averages and expectations for a period. But as Ty Busada of EdgePoint has said many times, we make money based on the decisions and discipline we exercise when times are uncomfortable. That is how favorable results are achieved. In the months ahead, the Newport team will be finalizing the first phase rollout of our new client portal, happening later this summer. You'll be hearing more from us about the portal and how we've invested in new infrastructure to optimize your client experience. As we all enjoy summer, we hope you can take pleasure in being with family and friends. Thank you for your unwavering trust in Newport. Know that your support is never taken for granted.